Hello everyone, and thank you for attending this evening's presentation. My name is Tom, and tonight we are very happy to welcome Leo Valencia from ElliottWaveTrader.net. I will share a link with you shortly where you can learn more about Leo and his history, including his PhD in physics from Stanford and the tech companies he worked for. But the aspect of Leo's career which I found most interesting is his history of data mining and problem solving. And after doing that in the tech and semiconductor arena, Leo then directed his attention to the financial markets. So today, Leo will be sharing more information about using Gamma to pick options contracts, and he will be educating us on his proprietary tool, which we call the Long Gamma Optimizer, and how it helps optimize options trading. So without further ado, please allow me to introduce Leo Valencia. Thank you so much for being here, Leo.
Thank you, Tom. And thank you everyone for joining. Welcome. Hope we have a great time this afternoon. And this is a talk about Gamma for options. And I think it will be useful for all of you, even if you're a beginner or an expert option trader, you'll get something out of this presentation. So the title of the presentation is Gamma and Other Demons, or I love the subtitle, Why Optionality is Not Leverage. So hopefully at the end of this presentation will be clear that leverage and optionality are two completely different things. So the first question that we have to ask ourselves when we trade options, and the focus of this presentation, the focus of how I approach Gamma and other Greeks is, why options lose value over time? That's the question that we have to face. And I know if you're an option trader, it's something that you are used to see all the time. Your options lose value with time. It is a fact of life. And most people don't challenge that notion, like why the options have to lose value? Why shares, for instance, don't lose value with time, or futures don't lose value with time? Only options seems to be the one losing value with time. Well, the answer is that there are many answers, but the answer to this question is a phenomenon called convexity. So time decay happens because options provide convexity of profits and losses. So what does it mean, convexity? It means that the profit and loss of an option is a non-linear thing. So in general, any instrument that exhibit non-linear profit and losses, or convex profit and losses, is an instrument that will lose value with time. And there are no exceptions, And the reason is that convexity is very valuable. So the value of convexity is being charged to you with time. So without further ado, here is a convex. This is how convexity looks. So this is a chart for an option. Let me get a pointer here. This is a chart for an option. When I did this presentation, XPX was at 2,800. Now you can tell that the market has moved quite a bit since then, more than 100 points. So this option was out of the money, and it had only 3 sessions left, only 3 days on it. And it was a very cheap option, only 85 cents. And this is what I call a profit and loss diagram. And it's a very simple diagram. On the x-axis, you have the different levels that the underlying can take. And on the y-axis, you have the return in dollars. And you notice, the first thing you notice is that as the underlying moves, as in this case, SPX index, as the SPX index moves, the profit on the option moves in a very non-linear way. So notice here this segment, how profits increase exponentially. I mean, they just completely explode. So if XPX moves 25 points, then your 85 cents become more than $5, which is a gigantic profit. Now we're talking about a massive profit here, almost 6 times the cost. And if XPX keeps growing, your profit keeps growing. Imagine $20 here. This is like a 25 times the cost of your option. And on the other hand, if the trade doesn't go well, I mean, if the market, instead of going up, goes down, you can see how losses are very small. In fact, you can tell that the losses are basically limit to the cost of your option. So this is a trade that could give you like tens of dollars in profit, but only 85 cents in losses. So right there, this is what I call a convex profit and loss profile. It's very different to the profile that you will get with futures or with shares. With shares, you don't get this nonlinear thing. You get a straight line, no? So this is how convexity looks. So notice something about the shape of convexity. First, the profit and loss chart is asymmetric. It's asymmetric because you have very small losses and you have gigantic returns. And right there is the answer to the subtitle of our presentation. Right there, we can see that options are not leverage. Options bring something else other than leverage, because if we were leverage, the profit and loss will be symmetric. The chart will be symmetric. It will be like a straight line symmetric, but no, because it isn't, then you can see that options bring something to the table that is not leverage. And that thing that options bring to the table is called optionality. And that's the most powerful thing you can have in options. So now the question is, okay, so when is convexity present? Let's say that I go out and buy an option, and okay, when I get my convexity, so well, convexity is present all the time during the whole life of the trade. From the moment you open the trade to the moment you close it, or to the moment the option expires, the option will exhibit convexity. However, the convexity of the option will change now. So the thing is, in options, this fantastic property called convexity changes with time to expiration, and it changes with moneyness. So this is very important. I mean, it's not constant. You don't get that nice chart all the time. The chart changes, no? So, and what is moneyness? Moneyness of an option is basically how far the option is from the current value of the underlying. I mean, if like you have an underlying at $100 and the option has a strike of 150 for a call, then it's kind of out of the money, no? So moneyness measures how far out of the money or in the money an option is, and convexity changes based on that. So remember, convexity changes with time to expiration and moneyness. So let's take a look here. Let's have a better look at this. So taking a look at this chart. This chart is a very similar chart. It's a profit and loss chart for the same option. But instead of plotting a single option, I'm plotting options with different expiration dates. And you can see that the dates are in days. Now, so an option takes 5 calendar days to expiration, another has 14, 26, so forth and so on. And I have one with a very long expiration, like 160, which is like probably 5 months away, So, and it's the same chart. You have levels the market can take and returns in dollars. And right there, you can see tremendous difference of behavior for these options. And you can see how convexity really changes with time. So notice how the red line, which is the option that expires in 5 days, notice how convex this thing is. This thing is incredibly nonlinear. This is probably the option that delivers the best profit and losses. I mean, the option initially doesn't profit that much, but it starts growing and growing exponentially. And look at the losses. The losses are really contained. So this is a reflection that this is a cheap option. So it's a very cheap option that delivers gigantic profits if the move happens. So notice how this thing is heavily nonlinear. But as we keep moving ahead, like 14 days now. So notice how 14 days, the convexity of the option, of the same option is not the same. The convexity of that option, the shape of the profit and losses starts to change. It's still not linear, but it's not the same. It's not delivering kind of the same fantastic profits, and the losses are getting bigger. And as I move in time, you will notice that convexity starts to disappear. And look at here at the extreme, with like more than 5 months away, these options exhibit almost no convexity. Look at this purple line. This purple line is basically a straight line. So this is a key insight for you folks that love to trade options. So the insight is, okay, options bring to the table a powerful property called convexity, and convexity disappears really quickly. So right here is a hint that, man, if you start trading options that really take a long time to expire, 5 months or more, you notice that there is almost no convexity in them. This option it behaves very similar to probably a future trade or a share trade where you get like a profit of a certain level and losses of the same level for the same type of move. So it's kind of very linear. So right there, let that thing sink in your mind that far-term options don't really bring you the true power of optionality. No, just think about it for a little bit. Now, let's look at the same thing, but with moneyness. So it's the same graph, and in this case, all of the options expire in the same time, and I just have different strikes. So of course, every strike will have different moneyness. Some strikes are closer to where XPX is. So for instance, this is where XPX is at 2,800. It was a coincidence when I did this chart. That was the value of the market at that time. But you notice I'm plotting a few options that are in the money. Those are calls that are in the money because they are below the current value of the market. I have one option that is exactly at the money, and I have a couple of options that are out of the money. Now, those are calls. So let's see how it behaves. Let's look at the in the money options. Notice what is the convexity of in the money options? That's the question I want to make. And notice that it's almost no convexity. In the money options have very little convexity. This is what you can see here, like kind of turning. It's not linear, but come on, this is as linear as it gets. But notice an interesting thing that is happening. If I pick options that are getting closer to at the money, I am starting to get some convexity. The at the money option, I will argue that is nicely convex. No, yeah, there is convexity in the money option. I mean, there is convexity on the losses. It looks kind of linear in the profits. But then once I move out of the money, I am starting to actually get tons of convexity. Look at the kind of like aquamarine line. It looks very, very convex. And look at the purple line. Come on, this purple line is incredibly convex. There's almost no losses and all gains. So by now, you have to be aware of two things. First, convexity changes with time, as in the past chart, and also convexity changes with moneyness. And it seems so that in order to maximize the amount of convexity, we want options that are not too far away in time, and we also want options that are out of the money, no? Because in the money options, don't deliver that much convexity or any convexity at all. So it seems that out of the money and kind of near term is the name of the game. Well, we'll explore this with more detail later on, but right now that's kind of the key insight that I want to deliver with these two slides. Okay, so now that we saw how convexity behaves, let's use the correct terminology here. So what is in a name? So the convexity of the profit and loss profile of an option is also called optionality. I have mentioned this already. So in the case of options, that nonlinear profit, the shape, this particular shape is called optionality. So when someone tells you, oh, I am doing this trade with optionality, what they mean is that they are doing a trade that delivers profit and losses with this kind of shape. And also, what is clear is that that's exactly what we want. I mean, as option traders, if we really are interested in good profits in using long options, I mean buying options, what we want is option trades that have lots of optionality. No, that's what we want. And so far, this is a discussion about the convexity of the profits and losses, the shape of the profits and losses, and the optionality of options. But the question is also, where does Gamma connect with all these things? I mean, you just say that this discussion is called Gamma and other demons, and I haven't seen Gamma at all. And the answer is yes, you have seen Gamma already. It's just that I have not explicitly mentioned it. So now I formally, Fox, introduce you to Gamma. Gamma is just a numerical parameter. It's just a number that quantifies the amount of convexity that an option possesses. So that's it. You know, other than being a Greek letter, gamma is just a number. It's a number that if it's a big number, it means that the option has high convexity. That's what it is. So you have a high gamma, an option with high gamma has high convexity. An option with zero gamma or an instrument with zero gamma means no convexity. So with this being said, I'm going to ask you like a little quiz, the easiest quiz ever. So based on this very simple definition of gamma, what will be the gamma of chairs, for instance? So chairs on a stock like Apple chairs or SPY chairs. What is the gamma of a chair, of an option chair? So just think about it for a second. And the answer is 0. Chairs have a gamma of 0 because chairs don't have convexity. So basically, pretty much everything out there has a gamma of 0. For instance, futures, most futures or almost all futures have no gamma. So that's it. So that's the easiest question to answer. Now, if someone wants to trick you in a job interview asking you estimate the gamma of an Apple chair, the gamma is 0. It's the easiest thing. Chairs have no gamma. Options have gamma, and the gamma of an option is basically is just shows how convex it is. So for instance, let's do a question. You can see right here that this option with 5 days has lots of gamma because it's very convex, and I can tell you that the gamma of every other option here in this chart is lower and lower. And for instance, the gamma for the option at 164, which almost looks like an straight line, is very close to 0. So you see, folks, gamma is not a difficult concept. It's actually very simple to understand. It's just a quantification of convexity. And because we know the properties of convexity, we shall know also the properties of gamma. If convexity changes with time to expiration, gamma also changes with time to expiration. If convexity changes with the moneyness of the option, then it means that also gamma, because gamma is the quantification of convexity, so gamma changes with moneyness. And then without further ado, here is gamma for all you guys. So this is a three-dimensional chart of gamma. Okay, and I always, at this point of the presentation, I always mention this. It's not an exaggeration. It's not hyperbole. This is probably the most important chart an option trader has to memorize in his lifetime. I mean, if you're an option trader, if you really want to make money in this thing, if you want to be successful, you have to memorize this chart. I mean, you don't have to memorize all those weird lines. What you have to memorize is the shape, the outline of the chart, and what the chart means, because contained with this unassuming bell-shaped curves of all colors is pretty much all of the knowledge that you need to make a lot of money trading options, right there. So let's dissect the chart. The chart is not that hard to understand. It's very similar. It has a x-axis, which is just the level of, the strike of the options. So those are different options with different strikes. And the y-axis is the actual value of gamma. So you notice the gamma is actually a number. It's kind of a small number, usually for options 0.005, 0.010, 0.015. It's a number, no? And then we have colors. This is why this is a three-dimensional chart. The colors represent different time to expirations in calendar days, like 5 days, 7 days, 10 days. So here, basically, I'm taking a bunch of SPX options, a lot of SPX options, and I'm creating this chart, computing the gamma for each of them, for each strike, and creating this plot. I mean, this plot requires thousands of options, but in general, what you want to memorize is the shape of gamma, because this is, I mean, I'm repeating it, I know, but it's extremely important to understand, okay? So the first thing you can see from the chart right away is a couple of things. The first thing is, if this is the value of the market was at 2,800 when I created this chart. And this is the value of gamma. You notice, what do you notice about peak gamma? No matter what expiration, you notice something about peak gamma. Peak gamma, the maximum amount of gamma of an option, tends to happen very close to the current value of the market. It's not exactly the same. It's not at the value of the market, but it's very close. And And this is a very peculiar thing of index options. And incidentally, you can tell that the peak gamma is kind of moving to the right as you as you move away in time. But let's ignore the fact. Let's just think that peak gamma tends to occur very close to where the market is right now, or your underlying in this case, because those are SPX options. So it happens really close to the value of SPX. Another thing from this chart that is very important to memorize is that gamma levels, you can tell how they dramatically decrease with time. So for the options that have 5 calendar days on them, gamma is kind of gigantic. I mean, the peak gamma, but then peak gamma starts to decrease dramatically. Dramatically. Look at this. This thing is with 91 days, with 21 days is nothing. And I put one at 91 days so you could see it's almost no gamma. The 91 days options is like 0.00002. I don't know. This gamma is almost not existent. And 91 days is only 3 months away. So you can tell that options that expires 3 months away have almost no gamma whatsoever, while options within the first month of trading have gigantic amount of gamma, but gamma comes back dramatically with time. So right there is a question that you have to, well, I mean, it is a fact of this chart that you will have to memorize. Now, gamma is more plentiful as time to expiration is closer. Now, look at the dynamics of gamma. Other than the peak, the peak happens not quite on the same level, and there is a reason for that. I mean, in a perfect world, peak gamma should happen here, but of course the world is not perfect, and in particular, index options suffer from lots of skew, which is someday, I can give a talk about that later on, but skew is just that calls and puts are priced slightly differently for index options. Puts tend to be more expensive. So the net effect is that it displaces peak gamma to the right. But in an ideal world, it should be perfectly symmetric. But even though with that displacement, you can see some symmetry. You can see that after peak gamma, you keep moving higher on out of the money. Gamma tends to kind of decrease. No, it drops dramatically as you move out of the money. But it also happens when you move in the money. You start moving in the money, and gamma starts to decrease a lot. For options in this area are way in the money. So it's a kind of a very interesting parameter. The gamma is more or less symmetrical. That's a very interesting thing that you have to also memorize from this chart. The gamma is kind of symmetrical. And now let's start with the life lessons. Okay, so I'm going to show you a quick way to make money just using this chart. Now, you don't need any fancy calculators or anything. You can just visually see how to make good money. Remember that if you remember, the gamma is a quantification of convexity. And you think, oh my God, I want to have the most convex option possible because that's the one that will deliver most of the gains. So you will be tempted to buy options that are around these strikes that are really close to the at the money, because you want to buy peak gamma, because you want to maximize your options. So just for fun, let's assume that we're going to do that. Let's see what happens if we buy peak gamma. Okay, so let's imagine that we buy this option here. There is an option here. I don't know what option will be that, like 2,810. Let's assume that is probably 10 or 8. I mean, some value like that. So we buy this option that has incredible gamma, and we are so happy that, man, we have so much gamma, we are going to be rich. But what happens if the market moves? Just think for a second. What happens if the market moves? Of course, if the market moves, the moneyness of your option will change, and therefore gamma will change. So right now, my option is a little bit out of the money. So imagine that this dotted line starts to move closer to your option. So what is happening to your strike is that your strike is starting to become more in the money. So what happens to gamma? Gamma starts to move along this particular curve. So when you bought the peak gamma, but as the market moves to the right, market is moving this direction, gamma is moving in along this line. So notice that for every movement of the market, the gamma of your option starts to decrease and decrease and decrease. And if the market keeps going more and more to the right, your option is becoming more and more in the money. So the gamma of your option is every time is less and less and less and less. And right there you realize, man, I'm losing money on this trade. Not quite losing, but I'm not making the maximum potential I could make because I already pay for peak gamma, and yet as the market is moving, as I am being right, as the thesis is actually happening, as I planned all along, my profits are not increasing at the speed that I want. In fact, my profits seem to be decreasing because gamma is decreasing, and if gamma decreases, convexity decreases, and your profits doesn't move at the same speed, and so you kind of have a terrible trade. So right there, as a person that wants to buy options, right there you realize, man, I should not buy anything that is here a big gamma. And the same applies to anything to the left. Even if you buy in the money options, you're buying options with at this area. And if the market keeps moving to the right, you are getting less and less gamma. So in the money options are even a worse trade. So for long gamma trades, don't do pick gamma or don't do at the money options because the gamma will always be lower. So instead of the trade, I'll offer you this one. What happens if you buy something that is out of the money? Let's say, for instance, the 2,825. Well, for all this discussion, we are imagining that the market is at 2,800, folks. I know it's almost 10,915, but let's imagine for a while that this is out of the money. So we bought this option right here out of the money with some gamma. Gamma is not that big, it's not that small, it's right there. But notice something interesting. What happens if the market starts to move to the right? If the market actually starts to go up, then my option starts to become more in the money. So as the market moves to the right, gamma of my option starts to move along this line. So gamma of the option, notice what is happening to gamma. The gamma of the option is actually increasing and increasing and increasing, which means what? It means that your profits are increasing and increasing at faster and faster and faster and faster speed. You notice that, no? You notice that this trade is fantastic. This is one of the best trades you can make because gamma is ramping up, ramping up, ramping up until a point where it peaks. And then it starts coming down. So that's the best trade ever. The best trade ever is to buy an out of the money option, let the market come to it, let your underlying come to it, and you are racking in profits and profits. But then you have to be aware that the option will peak. That option will peak and then gamma will come down. So the right thing to do is that sell the option once gamma is at peak value. So in general, this advice could be summarized as buy an out of the money option, hold it until it touches at the money, because let's assume that peak gamma happens at the money, just for easy to remember, and then we sell it. There is no point on holding an option that is becoming the money. There is no point. I know you think you're making money, and you are, but you're making less and less and less money as the market keeps moving. So it will be more efficient to sell and repeat the cycle. It will be more efficient to buy the option here, let it get peak gamma, sell it, and then buy another one. Your thesis is that the market will keep going up forever and ever and ever. So you see, folks, that's the methodology for a successful long option trade. You just buy cheap gamma out of the money and let it get fat, and sell with the gamma is the most plentiful, and don't hold an option after gamma starts to decline after passing peak gamma. Another thing, notice that if I pick different expirations, that if I have the luxury of picking expirations from my thesis, I should pick the one that is closer to my thesis. There is no point on picking options that are far away. I mean, if your thesis is that the move will happen within 5 days, then stick with those options. Don't play them with options that are far down. I know people love to say that I am going to buy, I think the market will go up 20 points in the next week, but you know what? I'm going to play this with 3-month options, because in 90-day options, because I want to give them time, because I want to have time in my favor. Well, you are doing nothing. If you're buying options with 90 days, look at the gamma you're getting. You're getting no gamma, guys. So what is the point? I mean, you are just just go buy some shares. Just go buy some futures. Just go buy some SPY shares. Why do you know? Don't even deal with options. If you are not willing to really exploit optionality, then don't play with options. I mean, if you're not comfortable with optionality, don't use options. Use something else. But there is no point after 90 days. There is almost no gamma to exploit here. So that's kind of the thing. So before continuing, I'm going to talk about some relationships. Of course, there is a price to be paid. If the only thing in life, the only thing to options is to buy cheap gamma and let it get fat, then everyone will be extremely rich. No, as I mentioned at the beginning, there is a connection between gamma and time decay, and the connection is intrinsic. I mean, there is no way to disconnect them. It is a law of the universe. You cannot, there are no free lunches. You can, I wish I could tell you otherwise, but high gamma means high time decay. That's it. If you pick an option with a high gamma, if you're playing for the high gamma things, that means that the decay of your trade is gigantic. In a more formal way, you know that there is a Greek letter that describes time decay for options. It's called theta. So in a more formal way, gamma and theta are connected and have opposite signs, and it is inescapable. And if you have a portfolio of options and if you are net long gamma, then you will suffer time decay, and there is no way around it. I mean, I know a bunch of folks when they discover spreads think that they could flip the sign of this and that, but it's unflippable. High gamma means high time decay, and it gives you a constraint on your option trades, because of course I would love to play these options with this incredible amount of gamma, but you know what? My options in 5 days will decrease in value so much. If the move doesn't happen, that's it. You are out of your capital. So you have to start compromising. Okay, man, I mean, I really want to play it, but I don't want to time decay into my profits. What should I do? So this is the first moving part that option trade is hard for you folks. I mean, it's not that easy. Conceptually it is, but in real life, because of this connection, it is tough. No? So you have to take into account that. And then before moving on, let's do the opposite. Let's sell options. I know a bunch of you like the concept of selling options, and I know the internet is full of advice about, forget about buying options. The money is selling options. So I will say most of those guys are full of air. It's a terrible advice. I will say optionality is the most powerful thing. Buying options in general is where the money is. I mean, here is how you actually make lots of money. But you can actually make money to selling options, but don't listen to any of the advice on the internet because it's terrible advice. People that love to sell options that are really far out of the money, thinking that they have very low probability of being in the money. For instance, if the market is at 2,800, someone will say, you know what, sell the 2,850 option because there is no way that the market will move 50 points in 5 days, and you get to keep the premium, and wow, this is a fantastic trade. And that's pretty much all of the advice out of the internet. The advice is expressed in many different ways, like iron condors or some selling vertical spreads that are really far away, but the advice is equally terrible. This is the worst thing you can do. If you're an option seller, please don't do that. I mean, I beg you, don't incur in this risk. You are doing the worst trade of your life. And this chart, which you should memorize or somehow take a snapshot of your screen right now and save it in the disk for later consultation. Just let's do it. Let's sell this option. So look at this. This option almost has no possibility of being in the money. It only has 5 days to expiration. What could possibly go wrong? No. So the first thing that could go wrong is like, look how much gamma you're selling. You're selling almost no gamma. You are taking a tremendous risk for no money. This is probably a few pennies. So you're getting a few pennies that you think they're safe. And just for a second, imagine that the market actually starts to move towards your target. Maybe not towards 2,850, but getting closer. So what happens to the gamma of your option? the gamma your option actually starts to increase. And it starts to increase dramatically. Look at that. The gamma is nothing. It doubles around here, and it keeps doubling dramatically with the smaller moves. So suddenly the market is around this point, and you are short gamma, and look at how much short gamma you are. You are racking up losses at a tremendous speed. Why will anyone want to do this kind of trade? I mean, why would you want to do this trade? Why would you want to be short something that can explode in your face? This thing will explode in your face, and this thing can bankrupt you, folks. You can lose way more money than you're making. I mean, you're making a few pennies, but suddenly you are in for dollars of losses here. So it makes no sense. The advice on the internet is wrong. For professional sellers of options, I mean, if you are into this thing, if you're really into selling options, you ask me if I want to sell options, I will sell peak gamma. You know, this is the easiest thing to sell. I will sell a peak gamma, and then I hedge it, I do something else, but I mean, this is the gamma you want to sell. Why? Because it's an expensive gamma first. You know, it's super expensive. And two, because no matter what the market does, I am winning. I sell peak gamma, and if the market moves up, then gamma decreases. And remember, I am short gamma, no? So I'm already making money because gamma is coming down. And you, on the other side, the same thing. So once you are here at the peak value, it really doesn't matter what the market does because of the symmetry of the gamma curve. You are actually making money. Of course, you need to do like a little more sophistication, but in general, this is the area where you want to sell. You want to sell juicy peak gamma, and you don't want to be exposed to gigantic risk. And even if the trade goes against you, I mean, imagine that the market keeps going down and your option gets in the money. Look at gamma. What happened to your losses? Your losses are kind of slowing down. But here, by selling this thing, your losses are actually moving up faster and faster. You can go bankrupt like this. You can never go bankrupt by selling peak gamma. Of course, I'm not encouraging you folks selling options with 5 days, 5 calendar days, and so near and naked. No, I mean this is a strategy has to be coupled with some hedging, but in general, that's what you want to do. You want to, if you are a seller of options, you want to be in this area. If you are a buyer of options, you want to be in this area. I mean, for calls, and for puts, you want to be in this area. No, it's the opposite. Anyway, so now we can talk about the next connection between Gamma and Vega. Vega is yet another Greek letter. I mean, we are full of Greek letters. And what Vega measures is the sensitivity of option prices to something called implied volatility. Implied volatility. What is implied volatility? Implied volatility is just kind of like a very nebulous concept. To me, the best way to explain it is it's just basically what option dealers want to charge you for an option. So option dealers have certain uncertainty, and this uncertainty is expressed as implied volatility. The higher the uncertainty, the higher the implied volatility, and also the higher of option prices. So Vega is kind of connects, okay, if implied volatility goes up a certain amount, how much is by what amount the price of my option will go up. So what it means is that high Vega means high sensitivity to implied volatility, and low Vega is low sensitivity. So interestingly enough, Gamma and Vega are connected the same way that Gamma and Theta are connected. You cannot remove the connection, folks. There is no trade that will remove this connection. But in this case, they have the same sign, but they are inversely proportional. What that means is if an option has very high Gamma, the option has very low Vega. And that's intriguing, just to start thinking about it. And vice versa. If an option has very low Gamma, the option has incredibly high Vega. And this, as I say at the end, this simple relationship has immense consequences for option trading, but tremendous consequences. You will think there is something kind of like, oh, innocent, but no, it is very important. So let's exercise again to the chart. So the question that I pose to you folks is, okay, based on this, what of these options have the lowest Vega? I'll let you think about it. I'll answer anyway. No. Of course, these options, the options with 5 days are the ones with lower Vega because they have the higher Gamma. Now, Gamma is very plentiful for these options, so Vega is very low. So in the opposite way, Vega increases for options with more time and more time to expiration. So in the extreme case, these options at 91 days have gigantic amounts of Vega, all of those options, all of the options here, because look at Gamma. Gamma is almost zero here. Those options exhibit tremendous sensitivity to implied volatility. And in the other side of the spectrum are these options. These options here with 5 days to expiration have almost no sensitivity at all to implied volatility. And there are tremendous consequences. And again, for those of you that love to trade real far away options, notice this, notice that not only you are missing on convexity, okay, not only you are missing the whole point of trading options, but you are incurring on incredibly high Vega risk because these options have gigantic Vega. So now you are incurring in a risk that you're not even aware of. Your position will lose money or actually make money. No, it could go either ways based on Vega than on price. I mean, it is the thing that will define your profit and loss is not the movement of the underlying, but the movement of implied volatility. So if for some reason implied volatility was expensive when you bought your option, and then afterwards it becomes cheaper, then doesn't matter what the market does, you're losing money right there. And with 91 days, Vega is kind of decent. I mean, it's big, but not that big. But imagine, I know people that love to trade options that have 1 year or 2 years. Now, those options are known as leaps. No, so I know people that love to trade leaps, and they think that they are trading like a stock replacement, but through the back door you are bringing incredibly high Vega risk. You are actually making your position. Your position is incredibly sensitive to changes in implied volatility, and that's a problem. And that's a tremendous problem, in particular for bullish trades. Now, if you are bullish, which is most people are bullish. Now, most people that buy options that expire in a year from now are doing bullish trades, are expecting either the market to go really high or expecting some stock to go really high. And it's a problem because during an upside move, implied volatility tends to fall, and you have these options that are very sensitive to the fall. So even though you are making some money within the upside move, you're losing lots of money with the fall of implied volatility. Okay, so summarizing these two things, summarizing everything I have said. If you want to speculate with Gamma and implied volatility, you have a couple ways to do. If you really want to just speculate with implied volatility, use high Vega options. What are high Vega options? Options that expire far, far away. No? And so you have options with low Gamma and longer expiration times. Now, if you want to short implied volatility, then you want to make sure that the short Gamma doesn't kill the position. So that's why you have to sell these options to close to peak Gamma as possible. Which is the example I gave you, that it doesn't matter where the market moves, Gamma decreases. No, so this is kind of a speculating with that. And now, finally, after all this long conversation, let's discuss how to optimize our long option trading. So to me, it's very simple. It's just buy low Gamma and sell high Gamma, or buy cheap Gamma and sell expensive Gamma. That's what it is. No, buy cheap Gamma and sell expensive Gamma. And the consequence of that is that you have to focus in near-term options. There is no way around. I mean, if you really want to leverage your trades, if you really want to use optionality, you need to use near-term options, something with 30 days or less, at least 90 days or less. No, don't go further than 90 days. There is nothing there for you. And also you have to do out of the money options. No? So coming back to this chart, try to focus on this region. Try not to go too far in expirations. Try to focus in this region if you can. Don't go too crazy. I mean, it's kind of a, juggling the ball. Like, this area is fine for options. And then we can go back to the, arrive at this particular slide. So the best thing to do for playing long trades with options is to select chip gamma, make sure that it doesn't decay much. Remember, the decay and gamma is connected. That peak gamma or the maximum gamma will be hit on the move that you want. And if the market doesn't move or the underlying doesn't move in the direction, you don't want it to lose that much money. And also you have to take into account like implied volatility risk, Vega risk in your trade. So if you do all these things by hand, you will come out with the perfect option. And of course, I know some folks are like, man, this is almost impossible to track. And the answer is yes, it's very hard to track manually. Luckily, I design a tool that does that. I mean, I have something called the long gamma optimizer. And the long gamma optimizer is just a mathematical tool, a simulation tool that picks the best option for your particular thesis based on all these things I just mentioned. No, it does all these things under the hood. And this is very different to any of the tools you can get with your broker. No one offers this because they just do analysis that doesn't take into account gamma. All of the analysis are okay after expiration, how much money you make, that's it. But this thing actually computes the best result that you have, the best option that you have for your particular thesis. And the gamma optimizer does that for you. You just need to have a thesis, which is a magnitude of time frame, and then we give you like 3 options, so you can pick. And I think that's all my presentation. I hope you enjoyed. I can give a little demo of the Gamma Optimizer. The Gamma Optimizer is just a web tool. Is that okay, Tom? I have enough time to give a little demo?
Absolutely. I think it'd be great to show them what it looks like.
Yeah, so this is the Optimizer tool. And so it's just a web app and you pick a particular symbol. So I love doing XPX. Now let's do XPX. It loads the whole option chain, which is gigantic. It's like 8,000 options and does all the magic. So let's load all the option chain for SPX. And then you can simulate a particular move. Let's say that right now, I am over bullish right now. Let's say the market will move 100 points in the next 30 days. So in other words, not 100 points, let's put 90 points. So the market will move towards 3,000 in a whole month. And what option should I use? So the Gamma Optimizer goes there, I click plot, and it just does something. Let's see what it does. And it recommends something. It recommends that if you want to play that move, I could use this option, the 2,965 option. It gives you a cost of how much it costs you, gives you a return for it, risk reward based on your stops. So it kind of gives you advice and also shows you a chart with different options. So you can see for every expiration, you can explore other strikes and see how much return you get, how much risk reward, in case you don't want you don't like any of my suggestions. Also, I can do this. I like to this because notice like an option that costs $9 is a very expensive option. So let's do something. Let's do a vertical call spread with 5 points wide and see how much it changes. Okay, so that one changes dramatically. Notice that different vertical spread of 2,995 gives you 900% return, which is gigantic, and it's very cheap. It's only 45 cents. So you're risking 45 cents and you're making $5. So it's a tremendous, more than 10x risk reward for this particular move. And you can see that with the Gamma Optimizer. I mean, it's a very useful tool for these kind of things. And it works for pretty much any American traded equity.
And Leo, the returns and the numbers that are being calculated there are using the mid price between the bid-ask spread for that option at that time, right?
That's correct. Yeah, in general, in options, when you trade options, and in particular options that are this expensive, this is XPX now. So when you trade options that are very expensive, or when you, in this case, which is this a vertical spread, you want to trade at mid. Mid is usually bid plus ask divided by 2. You don't want to take liquidity of when trading options. So always try to provide liquidity. Always try to get in between those two. And in something as liquid as SPX, it's always possible. I mean, I always get trades very near midpoint. So in this case, the mid is 0.45, and all of these returns are based on that.
So we had, as you know, and you covered it a little bit in terms of selling options, even though this is the long gamma optimizer, not the sell gamma optimizer. Someone commented about selling money secured puts, and depends on the situation, but obviously it would be a situation where they could take delivery, maybe would take delivery of the shares. Not that that necessarily matters, but the comment that they were talking about is that they were always kind of told and learned to look for was always told to sell the volatility. Is that in a disagreement with what you're looking at in the gamma, or how could they use also gamma to add to that strategy?
No, it's not in disagreement. I mean, yes, in general, the recommendation is that at the end of the day, the implied move, for instance, I'm showing you here in 30 days, the options are implying a move of 104 points. No, so usually where the price of the options are implying is always overpriced. No, and in general for index is always overpriced. And so yes, there is a good strategy in particular with index options, and more in particular with index puts. And this is only for index, no, not for normal equities, where selling the puts is actually make sense because the puts tend to be overpriced for the move. And the thing is, like selling, as the person mentioned, cash cover puts. So I mean, you are prepared to absorb the full loss is kind of very inefficient in terms of return. The return of the capital invested is not that efficient. But I mean, it has positive edge. It does have positive edge, and it's a valid trade. But in my case, instead of like taking this really very small, you're making just a few bucks every time that you do this, but you are taking tremendous risk against, if the market crashes, a single market crash can erase years of gains easily. So I don't like that kind of risk. I mean, this is not a risk profile that I like for me. But sometimes it could be possible to structure without unlimited risk. If you can find a way to mitigate risk, it can be done. Yeah.
Fantastic. So I do want to welcome anybody that has any other questions that you want to ask. We definitely open up the forum here. You can use the questions box to just submit those, and I'll forward those on to Leo. And then in terms, since we are here, Leo, we're on the site, we're looking at the long gamma optimizer tool, and we're waiting for some questions to come in. In terms of obviously, this Gamma Optimizer tool is something that's offered in your service, which we call Gamma Optimizer. To those of you that are here, we put in the chat box. You are able to get a 15-day free trial to Leo's service and to the Optimizer tool itself if you're interested, and there's a link there for you to get started. What else would people see? What goes on every day? Is it just you clicking the button and running more Gamma Optimizer tool ideas, or what goes on in the site and in your service each day? You don't have to talk about everything, but maybe pick an aspect of it or a type of other analysis outside of just the going long gamma that is discussed actively in your service.
Okay, yes. The long gamma optimizer is one of the tools we use. We use a bunch of tools now. So this is the tool that the talk was, this was the focus of the talk. But in the gamma optimizer room, we have a really nice banter daily about all sorts of things. Now, I can give you like a little example. I post a lot. I post ideas, analysis for the market. I do positions, long-term positions that are doing money, like trades for different things. In this case, for a trade for XOP, XLE. I mean, it's kind of back and forth. I do request trades, analysis, and we have something unique. Someday I will publicize. It's called the NDLA. This little thing here. The NDLA is some kind of deep neural network that seeks to look at particular patterns on the market, and it has been very successful for us. It has been one of the most successful things we do in the room for the last year. Now, this is kind of new. It has been 1 year, and the success rate of this thing is gigantic. So we do the NDLA. We have other tools, for instance. Let me show you other tools for you guys. Let's do optimizer here. I like to do them full window. We have something called the Momentum Center, which is a very useful tool where you can analyze all sorts of interesting things. Let me use SPY here, which has better data after the close. The Momentum Center is a tool where you can see different trends fast, which happens within 10 minutes, or slow trends that happen 5, 10 day, longer term trades. You have control charts, you have a variance chart that you can see. And I go over this several times a day, and it provides really good clues about what is going on in the market, both intraday and longer term. We also have a Gamma Central tool, which gives you even more information. I mean, we have lots of tools. I don't know, Tommy, you want me to look?
No, actually just a quick discussion. I know it's in terms of it's a much deeper topic, but in terms of the NDLA, what is it looking to do, since that has been one of for the service has been a tool that you launched that's been really popular and really beneficial to your members. What is that analyzing and telling us, and how often do you update it each day, and do you look to take trades around it? Just kind of an introduction, a quick introduction to what it is and how you're using it in the service.
Yes, the NDLA is a simple tool. It's use a neural network, like a deep learning thing. You want to use all the hot marketing terms now, marketing speak, but it's just a mathematical neural net that is looking for a particular pattern that is a 1% upside move in the market. That's what it looks for. Now it looks 1% moves up, and it gives you a probability of the move. And you can see past results here. So a positive probability starts at 0.5, but in the room, most people try to trade them from 0.4 and up. So you can see that predictions of 0.5, like this prediction here, like most of these predictions on this area were fulfilled. The market moved almost of 1% for those. And using some parameters, we take trades on them. For instance, we took a trade last week, exactly on the 22nd, for this target for 2,890. And as you can know, the market closed at 2,914. So this trade actually fulfill, max pay. It cost us like 65 cents to enter, and it delivered a profit of $5. So the trade delivered almost 10x on it. And that's what I do. I post this a couple times a day, and I decide if there is a trade to do there or not. And the trade is very long gamma. I mean, the trade is designed to leverage the chart that I showed you, folks. I mean, the trades that we do with the NDLA are exactly in this area right here, and that's why they deliver 10x. And that's what we do. No, we do that, and luckily, and I mean, we have had like great success. As a what is the name, as a warning, I mean, it doesn't mean that every week we have an NDLA trade. No, NDLA trades are possible. For instance, we have a negative signal today for next week, so there is no trade today. So we get negative signals, but when we do get positive signals, we take the trades, and we're seeking. That's what we are looking for. We are looking for trades that deliver more than 10 times the cost, or near 10 times the cost.
No, that's fantastic, because in the types of strategies that you're looking at, especially when we're talking about out of the money options, you're going to have some that just don't pan out as well, and that's where people need to consider position sizing and things of that nature. But you need to get some of those runners to help also work off some of the ones that maybe your thesis didn't play out, or it didn't actually point to the gain that it was expected.
Correct. Yeah, and that's why we want trades that deliver 10 times, because you can have 5 or 6 failures and yet still be up a lot of money.
That's fantastic. Well, we are coming up on the hour, so I know that we didn't necessarily get to all the questions everyone had, but we do want to welcome you to come in. As you saw, part of what Leo was showing when he was going through the room, there's a lot of posts from Leo in there, but there's also members asking questions. You can reply to his analysis and get clarification on something, or maybe pick his brain about an idea. It's also very common to see members maybe ask Leo for help about structuring an idea. So this is kind of what my thesis is, but what should I be looking at, or what could I be looking at? So that's another opportunity that goes on just really all day inside the room with Leo. And we hope that some of you will consider stopping in. Again, I'm going to put that link in the chat box here for you one more time quickly so you can go ahead and get started. If you've never tried the service before, you can get started with a 15-day free trial and see if it's something that you like and work for you. So Leo, just on behalf of myself and everyone that stopped in here today, I just want to thank you very much for taking time out of your busy schedule to be here with us and teach us about Gamma and how we can use it to improve our options trading. It's very, very educational. Thank you very much.
Thank you, Tom, and thank you everyone for attending.